Welcome to Business 311. This is from Chapter 3. These are activity ratios. We've already done the liquidity ratios. Now we're going to do activity ratios. This is for Business 311, Huntingdon College, and my name is Dr. James Joey. So right now we're going to talk about activity ratios. I'm on the wrong one. Okay. The first one that we talk about is, there we go, inventory turnover. You can think of this as basically how many times a firm turns over their inventory. So if they had, say, $1 in inventory and the cost of goods sold was $3, then you would have turned over your inventory during that period 3 times. Okay. So we're going to look at this number for a real life business here. We're going to do Bed Bath and Beyond. Okay, they're a retailer. They have cost of goods sold, etc. So the first thing we want to do is we want to get the cost of goods sold. Okay, and that is going to come from our, where do we go here? Income statement. Okay. They're calling it cost of revenue here for Bed Bath and Beyond, but that is cost of goods sold. So the cost of goods sold, remember these are in thousands, but we're going to ignore the last 3 zeros. The cost of goods sold was $7,867. Oops, wrong number. No, that's right. $867,810. And then we need to get their inventory. Now that's going to come off the balance sheet. You can see my finger there, but I'll put it right beside the balance sheet. So we're on the income statement. We're going to go to the balance sheet. Okay. Remember, inventory is an asset for this company, so assets go on the balance sheet. So here we look down here and we've got inventory of $922,000. We're cutting off the zeros, these are in thousands. So when we take inventory turnover, we take the cost of goods sold. That's how much we had in goods coming in over the year in terms of the cost that we paid for them. And inventory is the amount of inventory we have. So that's going to tell us how many times per year in this case, because these are annual figures, we turn over the inventory for this business. So we will get out our handy dandy calculator. Mine is the one on Windows, but you've got your own, the BA2 Plus. And we're going to take make this calculation. So the inventory turnover for this firm is $7,867,810,000 divided by $2,618,922. That's cost of goods sold over the inventory. We'll get that done here. 7,867,810 divided by 2,618,922, and we get a number of 3. So that means on average, this firm turns over their inventory 3 times. Now, there's a couple things we could do with this. If we were looking just at Bed Bath & Beyond to see where the firm is heading, we could go back over the past several years, calculate this inventory turnover, and see if it's going up or going down. If it's going up, that's generally a good thing. If it's going down, that's generally a bad thing. Okay? We could also compare this against a benchmark. Maybe one of our competitors who does real well with their inventory turnover and see how we match up compared to them. Or we could compare this to an industry average. Those are several things that we could do with this number. So if, let's say, Bed Bath & Beyond is 3.00 and the industry average was 3.8, let's say, I made that number up, then we would say, oh, Bed Bath & Beyond is turning their inventory over at a slower rate than the rest of their competitors. And that could add to extra cost. That could be because of bad sales, okay, or a slump in sales. Those things would be decided after we looked at the ratios. So going back to our PowerPoints, Okay. We're going to go to the average age of inventory. How old in general, or how long does inventory sit on the shelf or in the warehouse? Now, to calculate that, okay, our average age of inventory is equal to 365 divided by our inventory turnover rate or ratio. So that's going to be equal to, I'm going to move the camera down because you can't see any of that. Okay, there's our equation. Now we're going to take 365 and we're going to divide it by 3. Get our handy dandy calculator out. A better way of doing it would be to save this number, and that's what we're going to worry. Not going to worry about that. We're going to take 365, divide it by 3, and that tells us on average our inventory sits around for 122 and 2/3 days. Okay. Now, I'm not an expert on Bed Bath & Beyond, but I know that they're in some trouble, and that is probably not a good number. You don't want stuff sitting on your shelf or in a warehouse for 122, almost 123 days. Put that away. We'll go on to our next ratio. Okay, the next thing we're going to look at is average collection period. Okay, and this is the average amount of time needed to collect accounts receivable. Okay, this number gives us an indication of a couple of things. One, how good this company is at collecting on their receivables in terms of time from when they make the sale until they collect on that account. Now, it gives us an idea of how good they are at collecting, but more importantly, as this average collection period gets longer, that's also an indication that this company is extending credit to less credit-worthy borrowers or clients in order to increase their sales. So here we take average collection period, which is the accounts receivable, divided by the average sales per day. Now, there is no average sales per day entry on any of those financial statements. So we're going to go with the second equation here, accounts receivable divided by annual sales over 365. So we're going to make this calculation first, stick it in the bottom, then divide accounts receivable by average sales. So the first thing we need to do is calculate average sales. So if you look here, I'm going to put average sales, and that is equal to, now we're using data from Caterpillar. We can't use Bed Bath & Beyond anymore. They're a retail outlet, and they don't have accounts receivable. Annual sales, total revenue are the same thing here. And then we're going to divide that by 365. So when we look at the numbers here, total revenue for Caterpillar, I'll go to the Yahoo Finance page, is $55 billion, $750 million. Remember, these are in thousands. Divided by 365. And we're going to get average sales per day. So we go here, clear the old stuff off. I've got 55, 750, 1, 2, 3, divided by 365. So the average sales for Caterpillar are going to be 152 million $739,000. We got 3 zeros after that, but we're going to ignore them. So now we're going to take accounts receivable, divide it by this number, and that's going to tell us on average how many days it takes to collect on their receivables. So average collection is equal to average revenue, which is $17,452,000,000 divided by $152,739,000. Remember, the 3 zeros are cut off there at the end. Going back to our calculator, we'll make these calculations. 17,452, 123, divided by 152,739, and that is 114.26 days. So roughly, it takes them a little bit more than 114 days to collect on their accounts receivable. That is a very high number. But that would not necessarily be good or bad for Caterpillar. We would want to compare that to maybe previous numbers to see if their average collection date is getting longer or shorter over time. That would be an indication that maybe they are starting to extend credit to less credit-worthy buyers to increase their sales or total revenue. The other thing we might want to do would be to compare that to an industry average to see if they are on average higher or lower than their competitors. And then we could compare it against a benchmark, maybe a number from one of our competitors who's really good at collecting on their debts, and see how we're doing relative to them. So that is the third ratio that we've looked at today, average collection. All right, now annual average purchases per day are annual purchases over 365. I think that I did not include that 365 when we talked about before. So this is average purchases per day, which is annual purchases, also known as cost of goods sold over 365. So we're getting this data from from Yahoo Finance, and the accounts payable is going to come off of our balance sheet. I'm sorry, excuse me. It's going to come off of our balance sheet. So we go down here to liabilities. You can see right there, accounts payable. Okay, $7,051,000,000. Okay, and I've written that down here. The next thing we need is the cost of goods sold. I found that on the income statement, right? Cost of revenue, same thing. And we're going from this one. This is TTM. We're going for the statement that came out on December 31st of 2018. And if we scroll down here, we're going to find out that the cost of goods sold is $37,719,000,000. I went ahead and already calculated the annual purchases per day, and that is $103,339,000. So all we have left to do is to take our accounts payable, which are $7,051,000,000, and we're going to divide that by, I'm just going to call this purchases per day. And that is $103,339,000. Remember, again, these numbers are all in thousands. We're cutting off the last 3 zeros to make things simple. So now we'll make our final calculation. 7,051,000,000 divided by 103,339,000, and we get 68.23. So this, I'll give you a review there. this particular business, Caterpillar, pays its payables off roughly at a little over 68 days. Again, we can compare this over time. If this number is getting larger, that's an indication that that Caterpillar is having a harder time paying its short-term payables. On the other hand, if this number is getting smaller, that would be an indication that they're getting better at making their payables, accounts payable. Okay. You would never necessarily want this to be zero, but you certainly don't want it to be high. We wouldn't know if this is a good number for that industry until we compared it to, say, industry averages or a benchmark. Okay, that is the accounts payable. Sorry, I said accounts payable. Average payment period, 68.23 days. Okay, the next activity ratio we have is total asset turnover. This is an important one. You need to know this by heart, okay? And total asset turnover indicates the efficiency with which the firm uses its assets to generate sales. Okay, how good are we at turning these assets we have into sales or money? Okay, TATO, which we'll refer to it from now on, TATO, total asset turnover, is equal to sales divided by the total assets of the firm. Sales we're going to get from the income statement. Total assets we'll get from the balance sheet. This is for Caterpillar. So if we go back here to the income statement, I've already filled them in, but you can see here, remember, we want the end of the year, not this TTM. Total revenue for 2018 was $54,722,000,000. I've written that down under sales. Total assets comes off the balance sheet. This is the balance sheet that matches the income statement we just talked about. We're going to go down here, not total current assets, but total assets of $78,509,000,000. Now, one thing to look here is that these goodwill and intangible assets, a lot of times those are sort of unreliable numbers. We really don't want to count those as assets in some cases. Okay, goodwill, if a company buys another company and they overpay for it, so they pay $100 a share for it, and later out it turns out it's only worth $90 a share, they would take that loss and write it off as an asset called goodwill. Some cases, goodwill is actually a real thing. McDonald's, the name McDonald's tells you that you're going to get a standardized product. It's going to be taste the same as it does in every other McDonald's. So that would be counted as goodwill, but that brand value would sort of be that goodwill would be an estimate of the value of that brand. It's worth something. If everything went bad, you could still sell the name McDonald's to somebody, as long as it still had goodwill. So we're going to calculate TATO. We take these numbers. I've got 54 billion, trillion. Yeah, billion. 722 million. Sorry, my stand is, this stand is, I need a stand, a better stand. See everything. Okay, there's TATO. We're going to go to our calculator. We're going to take that 54,722,000,000 in sales, and we're going to divide that by the $78,509,000,000 in total assets that Caterpillar owns, and we're going to get a number of 0.697. So we'll just call that almost 70 cents. So what this number means is that Caterpillar is able to generate about 69.7 cents, or almost 70 cents in sales for every dollar in assets that they have. Now, in a lot of firms, that would be a horrible number, okay? But Caterpillar is a large capital good producing firm. They make tractors and construction equipment and all these other things. Those plants and assets that they have, one, are necessary to produce the tractors and things that they sell. And number two, might have very long lives. So for a large capital intensive industry like the tractor and construction equipment industry, that number isn't bad in and of itself. We would have to compare it over time through time series, see how the firm's doing over time. Is that number getting bigger or smaller? And we would also have to compare that against other firms in the industry, cross-sectional analysis, and see how they're doing relative to other firms. And then we could also compare it against a benchmark, against a number we either targeted or that maybe we find a competitor of ours who's very good at generating sales from their assets and shoot for getting our TATO up around theirs. Okay, we're going on to the next activity ratio. Actually, I made a mistake there. That was the last activity ratio that we're going to go over. Thank you very much for your time. I hope this helps, and have a great day.